Okay, welcome back to this quantitative finance program. In the last day where we ended, we have just started the credit rating analysis and credit rating agency. I had given a very brief background about Standard and Poor's, what are the rating schemes like those AAA, AA and so on and so forth, about Moody's also, and then I have basically differentiated in and clubbed them as per the norms. It's not what I am saying is basically as per the norms. Their credit rating and their default risk and their probability to default with corresponding to their the probability that they will give back all the money or they would not default. So, they are opposite to each other, but obviously we will see later that why it is important, in the sense that why both probability of default as well as probability not defaulting would be important. I will state that with a very simple example. And then we have also seen before that the concept of vega, delta, gamma, rho, and how the overall portfolio value rate of change of the portfolio value, which is basically the overall percentage change in positive or negative direction with respect to stock price, with respect to double derivative of stock price, with respect to standard deviation of prices, with respect to time, with respect to risk, all these things are important. And I also discussed, even though that was very fleeting, but I am sure you have got the gist of the concept, is that giving the Taylor series expansion, how you can find out all the terms correspondingly. And if you remember, because before I start off the class today, before you remember, I have discussed also about the Vena process, the Ito's lemma, and the simple derivation of the concept of Black-Scholes models. There also you use some sort of Taylor series expansion. So, for coming back to the rating process, so continuing our discussion in evaluating credits or the rating or the concept of default, non-default, the rating agencies use many of the same tools normally used applied to equity analysis. So, whatever we are discussing are basically the fundamental concepts of how a company or how an entity can be analyzed from the financial concept, and these are under the purview of fundamental analysis, which I did mention that it is used very heavily and you can get a good insight of information on the company. So, and that concept comes under the purview, partly under concept of accounting principles, that you know what is a profit and loss account, you know what is a balance sheet, you know what are the ratios and how the ratios are calculated, what is the concept of depreciation, what is the concept of different type of assets, liabilities, and how they are considered. So, these people who have a background in accounting or who are interested in get a concept of accounting and then go into fundamental principles and then follow the route which I have taken about the quantitative finance, that would give you a much better purview and an overview about the area of quantitative finance as such. Like quantitative finance as such is a standalone concept where you discuss more of quantitative techniques, but if you are well aware of the financial techniques also, then you have a much better grasp about the overall concepts of the fundamentals. So, coming back here, so they use the same tools normally used applied by equity analysts, but their approach differs in one key respect than rating agency have a much more longer time horizon. So, what I am talking is about the time horizon, and as you remember, I did mention in the last few classes time and again that volatility is dependent on time, then rate of change, which was in the generalized Wiener process. There were two concepts, A and B. So, drift rates and the white noise, the external volatility. So, they are dependent on time. So, those are important factors which are in some way considered by the credit rating agencies. They consider the business risk, industry characteristics like the seasonality, cyclicity. So, if you remember again going back to the forecasting method, we did consider the Holt winter method, the Holt method, the seasonality, and all these things were considered in a very simple terms. And I am sure the assignments for you to do, the assignment 1, 2, 3, when you will see, you will understand what was the relevance or what we had discussed in our lectures and how you can implement them using the small problems which are already uploaded in the web and which would be uploaded for different type of weekly sessions. Then the under the business cycle, the competitive position, whether it's a monopoly market, duopoly, oligopolistic market, where there's limited number of players, many players. So depending on the demand and supply, because if there are more number of players, the demand and supply basically comes to the equilibrium position very fast. So you will try to find out what type of market is it. Is it a very technically advanced market where products are being changed each and every day, or is a very stable market? Depending on that, you will try to analyze the overall concept of how the company is doing. You will find out what is the market share of the company, whether is it like Intel, or is it like, say for example, in Indian transport company, railways. So in case if you want to analyze the railways from their fundamental principles, whether their market share is huge, or they are the sole market leaders, or they are the only market shareholders. So depending on that, you will try to analyze how the company is doing. You will see, as I was mentioning, the technology, how technology is advancing. Is it a rapidly developing technology like in the IT sector, in the sector of mobile phones, or in computers, or is it some very old technology which is being still followed, depending on how the progress of the industry had taken place. You find about the efficiency, how the company is doing, and or what is the management principles. Do they want to really propagate the concept of technology, or concept of open discussions, and try to basically push forward the company's fundamentals and try to do better in the market. So obviously these, though they may not be considered quantitatively, but yet they are considered qualitatively. Then you also consider in the next bracket the financial risks. What are the financial characteristics of the company? What is the liabilities? What is the asset? What is total borrowing? Whether the interest rate is very high based on the fact that it has borrowed money from the market, or whether the shareholders or the actual promoters who have input money, they have their own money. So that means the overall level of risk for them is high, but overall level of risk for other investors would be much lower. What is the financial policy of the company? Do they give high dividends? Do they give low dividends? Would they plow back all their amount of money? If it's a technology advancing country, do they company, do they plow all their money in R&D development, or would they basically try to build up different type of or try to basically disburse that amount of money into the investors as dividends, or do they keep it as a coffer for next year's business, depending on how the company is doing. You will also try to find out, or the rating agency will try to find out, what is the profitability, what is the capital structure, how the capital structure has been broken up into depending on loans, assets, liabilities, and what type of assets do you have, what type of liabilities do you have. Is it a long term liability, is it a short term liability, is the overall risk for long term liability higher, is the overall risk for the low short term liability lower, depending on at what rate you borrowed the money. So you will find out the cash flow situation. So depending on when you need the money, whether there is adequate cash to basically help your company in order to basically run your business, do the marketing principles properly, have your money invested in sales, have your money invested in R&D, and so on and so forth. You will find out the financial flexibility, how flexible, how rigid is the company. Do they have a policy where they can go into the market and borrow money, or do they have their internal generation to a large extent where they are able to fund their requirements accordingly. You will find out the operating performance characteristics, the ratios. You will find out the ratios of EBITDA to the sales. You have to find out income tax to sales. You have to find out the effective rate of tax rate which is there. Is it a growing economy, or is it say for example, if you are trying to open up any business, or if a business in the area of non-conventional energy. So obviously you get a huge amount of tax relief, or you will have different schemes based on which you can get relief, financial relief. So what is your net income by the net worth? This is very high, or is it low? What is your overall ratio of net income to total assets, sales to fixed assets? Then you will also try to find out what is your profit before tax, what is your profit after tax, what is the dividend policies which you have. So all these things there are about 13 to 14 ratios based on which you can at least at a glance get a good view about how the company has been doing. And if you have the quarterly data, like less than that, it would be difficult for you to get from outside source. So if you have internally have the policies, you can get the data. If you have the quarterly data for, say for example, 3-4 years, so obviously it will give you a good idea that how the company is doing. So, there you have then have the financial ratios on the debt service coverage. You will find out the EBITDA by interests, the free cash flow minus the capital expenditure by the interest rate. You have the free cash flow minus capital expenditure minus dividend by the interest rate. So, interest rate is basically the amount of money which you have to pay for any amount of money which you have borrowed. The financial leverages would be long-term debt by capitalization, long-term debt by tangible net worth of the company, current liabilities which are there by the tangible net worth of the company, and so on and so forth. So, in the liquidity case, you have the current ratio, the quick ratio, you have the inventory net sales, you have the inventory net to net working capital, current debt to inventory, raw materials to total inventory, work in progress to total inventory, finished goods to total inventory, and all these things you will find out the cycle, how long the money is basically there in the market. In the sense, if for example, you are selling goods and the buyer says that he or she will pay back the money in 1 month or 2 months. So, obviously, that 1 month or 2 months is the lock in period of your money. So, you will try to basically get back that money as fast as possible. While on the other hand, if you are trying to pay your vendors, you will basically try to pay them as late as possible. So, these cycles by which the money is rotated by you in your company should be as soon as possible, such that there is no dead cash, in the sense the cash is not lying idle. You will try to utilize it as soon as possible. So, all these informations are collected in a general sense by the raters or the rating agency, and based on that they do the analysis. Then you also try to find out what are the receivables, are the aging of the receivables. This is the how fast you get, is it 30 days, 60 days, 90 days or 90 plus days, where if the receivables are very late, obviously they become bad debts. What is the average collection period? This is what I was talking about, that on an average how quickly is the money rotated, completes a cycle. So, that is known as the average collection period. So, rating agency proceeds basically in this way. A banker begins, I am considering from the point of view of bank only, a banker begins by finding out why the company needs a loan. So, if say for example, you as a company has approached for a loan from any industrial development bank or a bank for to run your business, obviously they will analyze, and they will analyze on different points. So, they will first analyze that why do you need a loan, do you have your own money, if so is the case, they will encourage you to utilize your own money or some part of that, so that they know that you are interested in running this business on a long term basis, so that you also face a amount of risk, not them only. So, using his or her preliminary knowledge of the company, the banker will test this need against the bank's current policy. Is the bank willing to lend a loan for a certain type of business? If the business is a very high risky business, and obviously then the propensity of the bank to lend that money for that business would be very low. If there is a green signal, then the bank basically proceeds. So, if all of them, so they generally you have a set of scores, like what is the business, what is the overall liability asset of the company, where from which different areas they are trying to basically run their business, what is the market share, what is the overall profitability of the company, what is the all the ratios which you have just mentioned in the last few slides. So, depending on that, the bank takes a decision whether it is going to go for a loan. The company's balance sheet and profit and loss account are analyzed to highlight the financial structure of the company. Figures for business segment operating results, budgets, business cycles are all helpful in trying to analyze what is the overall financial situation of the company. Hence, a thorough understanding of the financial statement is very necessary. So, again I am stretching, highlighting the fact that if you are interested to basically understand these policies of ratings, then obviously a very good thorough knowledge about accounting principles, ratios, financial statement is necessary. The trial balance is also analyzed, because if you before you make the balance sheet and the profit and loss account, you use the trial balance of the debit and credit concepts, and then you basically proceed. The trial balance is analyzed along with the supporting schedules, footnotes and the documents, and based on that you make analysis. The accounting principles are analyzed to see the consistency, how the good or bad the company has been doing in the last 3 or 4 years. Then the purpose of the loan is evaluated, so its projected cash flow is also analyzed. So, if you remember, the cash flow which I mentioned is basically, say for example, you are going to get a cash 2 years down the line. So, you try to find out what is the overall present value of that money, or else 3 years down the line you want to find out and what is the overall money would be obtained by the company, and then you try as a banker try to find out what is the overall projected money as of now. What are the hard and soft assumptions? You will try to analyze what is the overall management overview. Is it professionally run, or is it basically family run business? You will try to find out that how good or bad are the top managements, whether they are willing to take risk on their own account or whether they are very conservative. So, all these policies are analyzed. The industry structure is analyzed. If it is a very old industry, what you will try to find out as a banker, what is the competition, what is the market share, how the big the market is, how fast the market is growing, are there any other competitors, is it a oligopolistic market, is it a monopolistic market, is it a market where the thousand number of players are there and the demand and supply changes rapidly and it comes to the equilibrium very fast. So, all these things are generally taken care of. The company's executive management and their operating strategies are evaluated, as I was saying, that how the company is doing, what is the management. Managers involved with the specific projects, they are also evaluated, their overall policies of running the business, those are taken into account. Loan and security documents are prepared covering such issues as conditions of loans, how long the loans would be, what is the interest rate, who are the guarantors, what is the collateral and condition of default, all these things are analyzed. Now, what should the bankers think? Each industry has its own unique structure and dynamics. A firm's position is affected by the relative level of maturity of its bank. A mature industry, for example, is characterized by the market saturation, how saturated is the market, a lack of technology opportunities and a trend towards decreasing rate of return or increasing rate of return, all these things are analyzed. A firm attempting to prosper within any industry has to contend with potential and existing rivals, suppliers, buyers. Its competitive weapon may include barriers to entry, cost of control, economy of scale, cost of distribution, vendors, so on and so forth. Thus, when the bankers evaluators is trying to make judgment about the company for loans, all these things, advantages and disadvantages, should be considered very rationally. So, what are the problems of the banking? Generally, it is there are a lack of experts, domain experts, people who have good knowledge about accounting principles, who have good knowledge about industry experience, is really lacking, especially in India. Too much focus on any particular sector of the economy is also bad. So, if you are trying to analyze a company from its business perspective, you will try to see that whether the company is spread over all the overall economy or is only concentrated in any one sector. If it is concentrating on only one sector, obviously you will try to see that how it has been doing in the long run or past 3 or 4 years in that particular sector. Whether there is biasness, so considering that the economy is doing well or economy is not doing well, whether there is biasness in trying to evaluate that decision of trying to give a loan should also be done away with. External dictates so as to lead to particular sector or a company should be avoided as far as possible. Do not go for that. But obviously, you will ask a question that let us consider a very simple example. We have the State Bank of India, which is the Bank of India, and we all know, but they have businesses in very remote parts of India, which is not profitable for them. That is true. But you should also understand the fact that considering the overall economy and considering the government's mandate that it has to basically serve the poor and the people from the rural areas in remote parts of India, the strategy of trying to have State Bank of India is very good. So, obviously, I am giving an example. So, if a company like that approaches the banker or approaches the rating agency in order to be evaluated, so all these things should be taken into account, whether it is able to fulfill some of its social and so called obligations to the society. So, these are some of the non-quantitative effect, very qualitative effect, very subtle effects which has to be considered by any rating agencies. Unforeseen circumstances. Say for example, we all know about the devastating effect of Mumbai effect, which has during the bombing in Mumbai and what effect it had on the financial situation. Or say for example, you consider the bombing effect in USA. So, all these things, if they have a devastating effect on the economy, we are not aware of that a priori. So, you should also be able to take care of such unforeseen circumstances such that you can foresee that if there is some unforeseen circumstances, what is the overall risk or default the company will face and you as a banker are willing to basically take care of. Now, we will consider that very simply what are the credit models and why a credit model is needed. So, deregulation which stimulated financial innovations and enabled new entrants to provide services came into the market, and obviously, as different players came into the market, you have to basically have different models in order to evaluate their credit worthiness. The broadening of the credit market to encompass new borrowing sectors also came into being. So, initially as we saw in the initial part, the overall industry, if you span its overall industries growth throughout the world, in the last 200 years it has been more of an industrial development where more manufacturing was laid stress on, and slowly then it became a more of, now it is becoming more of a service one. It is not that manufacturing is decreasing, but it has reached a level where now in comparison to that service sector is basically increasing. So, obviously, if somebody, if you are trying to basically plan to give loan to a service sector industry, keeping in mind the basic principles of the manufacturing industry, that would not be right. So, you have to basically evaluate it accordingly. A continuing shift in the balance sheet, lending to the balance sheet account or lending to the cash flow, and how the cash flow is happening, that should basically be analyzed very thoroughly in order to understand the credit models. Again, I am laying the stress, the balance sheet, the trial balance and the profit and loss account in details, if they are studied, that gives you a lot of information how the company is running. So, with this we will end today's class, at least not the overall concept of credit rating models, but we will continue our discussion in the next class and try to wrap up the why credit rating models are utilized, and then continue discussing what are the different type of credit rating models which are used in general to analyze different problems. Thank you.